We have all been sold a massive, generational lie that has dictated the course of millions of lives and shaped the modern global economy. Since childhood, the formula drilled into our heads by the traditional education system, well-meaning parents, and society at large is remarkably simple, yet deeply fundamentally flawed. If you want more money, you have to work harder. The societal prescription for financial success has always been tied directly to physical or mental exertion. We are taught to take on extra shifts, start an exhausting side hustle, endlessly climb the corporate ladder, and grind 80 hours a week until we eventually burn out in the pursuit of a larger paycheck. This conditioning has roots in the Industrial Revolution, where laborers were literally paid for the exact amount of time they stood on a factory floor. We inherited a factory worker mindset in a digital, capital-driven age. But if you pause and look closely at the architecture of modern wealth, you will notice a glaring contradiction that shatters this illusion. The people working the hardest, performing the most back-breaking labor, and clocking the longest hours are rarely the wealthiest. In fact, they are often the most financially trapped, living paycheck to paycheck, endlessly running on a hamster wheel where their time is entirely consumed by the struggle to survive. On the absolute opposite end of the spectrum is Warren Buffett, universally recognized as one of the most successful investors and one of the richest men in human history. He has built a net worth exceeding $130 billion without ever pulling all-nighters, breaking a physical sweat, or stressing over hourly stock charts. He does not hustle in the traditional exhausting sense of the word. Instead, he spends the vast majority of his day, often estimated at around 80%, simply sitting in his office reading corporate financial reports, studying books, and thinking critically. To win the ultimate money game without trading every waking second of your limited, precious life for a paycheck, you must completely rewire your understanding of how wealth is generated, mastering a few core immutable principles of capital allocation, psychological discipline, and long-term strategic patience. The fundamental, defining difference between the struggling middle class and the ultra-wealthy comes down to the underlying mechanics of how their money is generated. The middle class works for money, whereas the wealthy meticulously build systems to make their money work for them. Buffett once famously noted that if you do not find a way to make money while you sleep, you will work until you die. This single, profound quote encapsulates the entire philosophy of true financial independence. When you work a salaried job or get paid by the hour, your income has a hard mathematical ceiling. There are only 24 hours in a day, and you must spend a significant portion of them sleeping, eating, recovering, and commuting. Even if you become a highly paid specialist, such as a neurosurgeon or a high-powered corporate lawyer billing $1,000 an hour, your wealth is inherently capped by your physical presence and finite energy. If you stop operating or stop billing hours, the money instantly stops flowing. You are the sole engine of your wealth, which means your wealth is extremely fragile and constantly vulnerable to illness, exhaustion, or age. To shatter this ceiling, you must transition your identity from a wage earner to an owner by acquiring productive assets. An asset is an economic resource that puts money into your pocket whether you are awake, asleep, on a tropical vacation, or sick in bed. Buffett views capital fundamentally differently than the average consumer. Most people look at a $100 bill and see a means of immediate consumption. It represents a new pair of shoes, a fancy dinner, or a fraction of a car payment. Buffett, however, views every single dollar as a potential employee. When you spend $1 on a depreciating liability, something you do not actually need that loses value the moment you buy it, you have permanently fired that employee. That dollar will never work for you again. However, When you invest that dollar into a productive asset, it goes to work for you 24 hours a day, 7 days a week, 365 days a year. It never asks for a day off. It never complains about working conditions. It requires no health insurance. And most importantly, it eventually starts recruiting other dollars to work for you too. This shift in mindset from trading time for dollars to exchanging dollars for permanent working assets is the non-negotiable first step to financial freedom. If decoupling your time from your income is the structural foundation of immense wealth, compound interest is the unstoppable engine that drives the vehicle forward. Physicist Albert Einstein purportedly called compound interest the eighth wonder of the world, famously stating that he who understands it earns it, he who doesn't pays it. It is no coincidence whatsoever that Warren Buffett's official biography is titled The Snowball. To truly understand how Buffett won the money game without outworking everyone else, one must study the fascinating timeline of his wealth accumulation. The numbers are not just impressive, they offer a profound lesson in the mathematics of patience. Buffett started his entrepreneurial journey young, famously buying pinball machines and placing them in local barbershops, allowing the machines to make him money while he was in school. By the time he reached age 30, he had accumulated $1 million. This was an impressive feat, but it was only the beginning of the mathematical curve. By age 50, that net worth had grown to $300 million. Today, in his 90s, he is worth over $130 billion. The most staggering realization is that over 99% of Warren Buffett's immense wealth was generated after his 50th birthday, and a vast majority of it came after his 65th birthday, which is the traditional age when most people retire. Buffett did not suddenly become 1,000,000 times smarter at age 65, nor did he suddenly start working 1,000,000 times harder. His capital simply reached a critical mass where the compounding effect became exponential and entirely unstoppable. Compound interest is the process of earning interest on your principal investment, and then earning interest on that interest in all the subsequent years. Like a small snowball rolling down a long, snow-covered hill, it starts off small, slow, and unimpressive. But as it rolls, it picks up more snow, growing larger and rolling faster until it becomes a massive avalanche. You do not need billions or even millions of dollars to start this process. The most important variable in the compound interest equation is not the amount of money you start with, but rather the amount of time you allow the money to compound undisturbed. If you were to invest just $300 a month, roughly $10 a day, which is less than the cost of a modern fast food meal, into an investment that averages a historical 10% annual return, you would have roughly $60,000 after 10 years. But if you leave it alone for 30 years, you would have over $680,000. Leave it for 40 years, and you would have over $1.8 million. Your total out-of-pocket contribution over those 4 decades would be a mere $144,000, while the remaining $1.65 million was generated purely by the mathematical magic of compounding. You did not work a second job for that money. You did not sacrifice your weekends, and you did not invent a revolutionary piece of technology. You simply, consistently planted small seeds and allowed the fertile soil of the market and the long reign of time to do all the heavy lifting for you. Despite the proven mathematical reality of compounding, the biggest mental roadblock to investing for the average person is the paralyzing, culturally ingrained belief that they need to be a financial genius to succeed. Society, aided by a sensationalist financial media, constantly tells us that to make money in the stock market, you must be exceptionally brilliant. You are led to believe that you must be able to read complex corporate balance sheets, monitor multiple screens of flashing red and green numbers, predict unpredictable geopolitical events, and somehow pick the next hyper-growth company, like the next Apple, Tesla, or Nvidia, before anyone else in the world discovers it. Warren Buffett emphatically argues that this is entirely false and incredibly dangerous. He suggests that 99% of ordinary people should not even attempt to pick individual stocks. The risk is far too high, the time commitment is exhausting, and the emotional toll almost always leads to catastrophic financial mistakes. Instead, Buffett's official, heavily publicized recommendation for the vast majority of investors is brilliantly, intentionally boring. A low-cost S&P 500 index fund. The S&P 500 is a stock market index that tracks the collective performance of the 500 largest, most dominant, and most profitable publicly traded companies in the United States. It includes titans across all industries, from technology and healthcare to consumer goods and financials. When you purchase a share of an S&P 500 index fund, you are not betting on a single CEO's vision or a single product's success. You are effectively buying a microscopic slice of the entire American economy. You are placing a long-term bet on continuous human progress, relentless corporate innovation, and inevitable economic growth. The true genius of the S&P 500 is that it operates as a self-cleansing, automatically updating portfolio, requiring absolutely zero active management on your part. If one of the 500 companies begins to fail, go bankrupt, or lose its market dominance due to mismanagement, its market capitalization shrinks. It is then automatically kicked out of the index and immediately replaced by the next rising star in the economy. You never have to worry about holding a stock that goes to zero, because the index inherently weeds out the losers and promotes the winners automatically. To definitively prove the superiority of doing absolutely nothing, Warren Buffett made a highly publicized $1 million bet in 2007 against the elite, heavily compensated hedge fund industry of Wall Street. He challenged the brightest minds in finance, betting that a group of highly paid hedge fund managers, individuals armed with Ivy League degrees, massive supercomputers, and sophisticated high-frequency trading strategies, could not beat the long-term returns of a basic, low-cost S&P 500 index fund over a 10-year period. A firm named Protégé Partners accepted the bet and selected 5 complex funds to compete against Buffett's chosen Vanguard S&P 500 index fund. The results of this decade-long experiment were a devastating, humiliating blow to the active management industry. Over the 10-year period, which notably included the massive, devastating 2008 global financial crisis, Buffett's passive, unmanaged index fund compounded at an annualized rate of 7.1%. The highly managed, incredibly stressed hedge funds returned a dismal 2.2% net of fees. Why did the supposed experts lose so badly to a strategy that requires zero thought? The answer lies in the friction of fees and the arrogance of active trading. Active managers charge exorbitant fees, often taking a 2% flat management fee plus 20% of all profits. Furthermore, every single time they buy and sell a stock, trying to outsmart the market, they incur trading costs and trigger taxable events. An index fund, by contrast, simply buys the broad market and holds it indefinitely, charging a microscopic, almost invisible fee. This index strategy requires zero extra work from you. You do not have to watch the chaotic, fear-mongering financial news networks. You do not have to panic when a high-profile CEO is fired or a corporate scandal breaks out. You just automatically direct a portion of your income into the fund every single month and go live your life. You can go spend quality time with your family, focus on your physical health, travel, or pursue your hobbies. You are actively winning the highest stakes money game in the world while doing absolutely nothing. However, having the right asset and intellectually understanding the mathematical power of compound interest is only half the battle. The other half, and arguably the much more difficult half, that destroys most people's wealth, is entirely psychological. Warren Buffett often notes that investing is not a game where the person with a 160 IQ automatically beats the person with a 130 IQ. Once you possess ordinary intelligence, what you truly need is the emotional temperament to control the irrational urges that constantly get other people into trouble. The stock market is essentially an endless, global tug-of-war between two powerful, primal human emotions, fear and greed. Historically, the stock market experiences a correction, defined as a drop of 10% or more, about once a year, and a severe bear market, a drop of 20% or more, every few years. There will inevitably be terrifying economic recessions, geopolitical conflicts, unexpected global pandemics, and terrifying news headlines claiming the end of the financial world is imminent. During these periods of extreme volatility, your investment portfolio will lose significant value on paper. This is where the average investor spectacularly fails. They watch their hard-earned money shrinking on a screen. They listen to the apocalyptic news anchors screaming about the end of the economy, and they sell their investments at the absolute bottom of the market out of sheer, blinding terror, permanently locking in their losses. Buffett's approach to market chaos is the exact opposite of the general public. He operates by a famous, unwavering psychological rule: be fearful when others are greedy, and greedy when others are fearful. When the market crashes and blood is in the streets, Buffett does not panic. He goes shopping. He views market crashes not as tragedies, but as massive, generational discount sales on the very best companies in the world. If you liked a high-quality pair of shoes at $100, you should logically be thrilled to buy them at $70. The exact same logic applies to buying index funds. When you are systematically investing every month through a process known as dollar-cost averaging, market downturns actually work heavily in your favor because your fixed monthly contribution automatically buys more shares at drastically cheaper prices. When the market inevitably recovers, as it always has throughout the entire history of modern capitalism, those accumulated shares you bought at a steep discount will drive explosive, life-changing wealth growth. On the flip side of the psychological coin, one must also rigorously control the destructive emotion of greed. Every few years, a new financial craze sweeps the nation and dominates the cultural conversation. It might be dot-com stocks in the late 90s, leveraged real estate in 2006, or obscure cryptocurrencies and volatile meme stocks in the modern era. During these massive speculative bubbles, people around you will loudly boast at parties and on social media about making massive sums of money overnight with zero effort. The temptation to abandon your boring, reliable index fund strategy to chase the hot new trend will become almost overwhelming. Buffett avoids this trap by adhering strictly to what he calls his circle of competence. He simply refuses to invest in things he does not fundamentally understand, no matter how much money other people claim to be making. If you abandon your long-term, calculated plan to chase quick riches, you are no longer an investor. You have become a gambler, and in the vast casino of short-term trading, the house always wins eventually. To win the money game without working more, you must have the emotional discipline to accept slow, guaranteed wealth over the seductive illusion of rapid, overnight success. Finally, making money and successfully automating your investments is merely playing a fence. But as in any competitive endeavor, you cannot win a championship without an impenetrable defense. In the realm of personal finance, the ultimate enemy of your defense is a silent, pervasive, psychological phenomenon known as lifestyle creep or lifestyle inflation. Human behavior follows a deeply predictable, consumer-driven pattern. When a person graduates from college and secures their first entry-level job, making $40,000 a year, they manage to survive. They live with multiple roommates, drive a beaten-up used car, and cook their own cheap meals. A few years later, they earn a promotion and are now making $70,000. Suddenly, the reliable used car feels inadequate, so they finance a brand-new vehicle with a hefty monthly payment. They ditch the roommates and sign a lease on a luxury one-bedroom apartment downtown. 5 years later, they climb the ladder again and are making well over $100,000. Now, societal pressure dictates they need a much bigger house in a prestigious neighborhood, designer clothes, an expensive watch, and lavish international vacations to post on social media. Despite tripling their income over a decade, they are still living paycheck to paycheck, one emergency away from financial ruin. Their expenses grew in exact tandem with their earnings, quietly stealing their future. Because of this uncontrolled lifestyle creep, they have absolutely zero surplus capital left over at the end of the month to feed their investment snowball. They have trapped themselves in a gilded cage, forced to continue working high stress, demanding jobs indefinitely, just to maintain a sprawling lifestyle they have merely become accustomed to. Warren Buffett is the absolute ultimate master of playing defense against this exact phenomenon. Despite having immediate access to unimaginable, limitless wealth, his lifestyle remains shockingly, famously grounded. He could easily purchase private islands, fleets of mega yachts, and hangars full of supercars without making a microscopic dent in his net worth. Yet, Buffett still lives in the exact same 5-bedroom stucco house in a quiet neighborhood in Omaha, Nebraska, that he purchased in 1958 for a mere $31,500. He does not live in a gated, fortified mega mansion in Beverly Hills or a sprawling penthouse overlooking Manhattan. He drives a standard, modest car that he keeps for many years before replacing. He does not collect luxury watches or wear bespoke Italian suits that cost as much as a car. On his daily 5-minute commute to the office, he frequently stops at the local McDonald's drive-thru, purchasing a breakfast that costs exactly $3.17 or $2.95, depending entirely on how the stock market is performing that specific morning. The profound lesson to extract here is not that you must live like a miserable monk, deprive yourself of all earthly joy, or eat greasy fast food for the rest of your life. The deep underlying lesson is about understanding the massive chasm between being rich and being wealthy. Being rich is simply a measure of current income and visible consumption. It is the flashy sports car roaring at a red light, the massive mortgage on a McMansion, the designer labels plastered across clothing, and the VIP tables at expensive nightclubs. Rich is inherently loud, performative, and often deeply insecure. Being wealthy, on the other hand, is entirely hidden from the naked eye. Wealth is the money you consciously choose not to spend. Wealth is the massive, unseen portfolio of index funds quietly compounding in the background while you sleep. Wealth is not a luxury car. Wealth is the absolute freedom to wake up every single morning, look at the ceiling, and say that you can do whatever you want with your time today. By keeping his ego entirely detached from his spending habits, Buffett ensured that the maximum possible amount of his capital was always available to compound and grow. If you can keep your cost of living remarkably low and aggressively resist the biological urge to upgrade your lifestyle every single time you get a raise, you capture the financial spread. You continuously feed the snowball. More importantly, by maintaining low overhead and rejecting rampant consumerism, you completely remove the suffocating pressure to work extra hours, take on stressful promotions, or endure toxic corporate workplaces just to pay for things you do not genuinely care about. To truly implement this billionaire blueprint into your own life and win the money game without eternally trading your time, you must take concrete, automated action that removes human error from the equation. You must permanently divorce your mind from the archaic idea that harder physical work equals more wealth, radically reframing your entire worldview to become a permanent owner of capital rather than just a consumer of goods. You must ruthlessly automate your financial offense by setting up bulletproof systems where a fixed, non-negotiable percentage of your paycheck is immediately routed into an investment account the exact moment you are paid, long before you ever have a chance to rationally justify spending it. You must direct those automated funds consistently into broad market index funds, choosing to buy the entire haystack rather than exhaustingly searching for the needle. And above all else, you must cultivate absolute, unwavering stoicism. When the market inevitably dips, when recessions strike fear into the hearts of the public, and when the news headlines incite mass panic, you must do absolutely nothing. You must ignore the deafening noise, let the compounding snowball continue to roll down the hill, and always remember that true generational wealth is measured in decades, not days. By automating your investments, fiercely minimizing your lifestyle creep, and letting the vast mechanics of the market do the heavy lifting, you secure the ultimate luxury that money can buy: absolute financial freedom and the total uncompromised ownership of your own life.